there's a couple of you I don't know, and would be glad to get to know you and see how we can help you out. Ravinia is investment bank, and looking forward to this panel. I think that this year has just been one of the most interesting. I'm like a deal junkie, as a lot of you are, and it's just been a very unusual year, and it's kind of interesting. You know, where are we right now, and what's going on, with values, and you know, it's been several years of kind of the same, and I think things have changed dramatically. You know, starting last fall, and then heading into this first quarter. But I think it's, you know, where we're at right this moment as far as deal flow and valuations. It's, I'm very curious to see what the panel says. I'll have my own opinions, and I'm curious what everybody out here in the audience says. We've got a truly great panel here of middle market experts. I mean, these are people that, you know, are in the game day to day, very active, and from around the country. These are some of the best people we've assembled. They really tell you what's going on. So this is going to be a real treat. Rather though than introduce, what I'm going to do is start with each of them and let them kind of tell you a little bit about their firm and who they are, and you know how many years they've been in the deal business themselves. So we'll start with Eric on the left, and and just tell us a little bit about the IB practice at your firm, and a little bit about yourself. And feel free take your time, because I think it helps everybody understand more when they know where you're coming from.
Thanks very much. Yeah. So I'm Eric Reuther with Stout, Risius, Ross, SRR. Steve told you a little bit about what the firm does. So maybe I'll just talk a little bit about what our investment banking group does. Right. It's mostly sell-side mergers and acquisitions. We do select buy-side work and select capital raising, but really, as I look at the deals we're working on right now, all but one or two are sell-side M&A. Right. We go to market by industry vertical, but really at the end of the day, we're an industrials shop. We do almost anything in and around the industrials vertical. We also have a good consumer practice. We do operating real estate. In terms of deal size, we really sort of, probably our sweet spot is, call it, $30 million of enterprise value on the low end to about 300 on the high end. We certainly do deals above and below that space, but that's where the majority of our transactions are. So a little bit about myself. Let's see, I started banking in '98 at what was then the First National Bank of Chicago, and kind of been in and around Chicago since then. I spent a lot of time at BMO. That's kind of where I grew up in the investment banking world as an industrials coverage banker, doing universal banking for them. The sort of second half of that time, I began to really spend a lot of time in and around the aerospace and defense industry, and that's what I continue to spend a lot of my time on now. I joined Stout, Risius, Ross about 2 years ago to do middle market sell side M&A, really focused on aerospace and defense, but also broader industrial transactions as well. Like probably everybody in the room, you sort of get to know people in and around the broader industry, and you're surprised where things come from.
Thanks, Eric. Greg?
Greg Lafin, BKD. BKD is the 12th largest CPA firm here in the country. I lead our Chicago office, which is one of 5 offices throughout our firm that does investment banking. We also have Tony Giordano, who leads our investment banking practice in the back of the room. BKD is an investment bank, focuses on transactions about $300 million, enterprise value down to about $3 million. So we have a wide range of activity. We do have 2 specialty niches within our group. One is community banking, where we see some robust activity on the banking side with all the merger and acquisition transactions going on in consolidation. The other is healthcare, healthcare services, hospital, strategic affiliations, and then we see a lot of activity in continuing care and extended care facilities as well. But for the most part, the bankers that we have, we're a small group that service all 36 offices of BKD, is industry agnostic. And we're blessed that we've seen a continued flow of strong deal flow. and activity. And it looks like like most CPA firms, we have a fiscal year end. So our fiscal year end for this year is coming due May 31st of 2016, and it looks like it's going to be another record year for us.
Great. Andy, first Andy.
Good afternoon, I'm Andy Crain. I'm a partner with Mirus Capital Advisors in Boston. We're a boutique M&A shop that's been around for close to 30 years. We cover most sectors of the New England and Northeast economy. Originally, for the first 10 plus years or so, we were primarily doing venture capital exit work, and then with the dot-com implosion, we switched to representing primarily owners of privately held companies, entrepreneurs, management team, family businesses. I cover the consumer sector, having run my family's food manufacturing business in the Boston area for over a decade prior to selling that back in late 03, early 04, and pivoting to investment banking at that point. A bit of an odd inflection point, but it was informed by the fact that it started as a corporate attorney before getting sucked into the orbit of the family business. So this was a way to kind of combine those experiences and get back on the professional services side of things. As I mentioned, I cover the consumer products sector. Like Eric and Greg, deal flow begets other deals, so I've ended up doing quite a bit in construction and building products, as well as some electronic manufacturing work in the New England market as well. As a firm, with our background doing venture exit work, we're still heavily focused on tech and software transactions. More recently, with the Boston economy being focused strongly on healthcare, we're doing quite a lot in the ancillary services in and around healthcare. We don't really touch peptides and molecules, but anything servicing that we'll get involved with. We also do a lot of outsourced business service transactions, and if anyone has a ski area to sell, we're the preeminent ski area M&A firm in the country.
Andy?
I'm Andy Greenberg. I run GF Data. We're the largest collector of valuation, volume, leverage, key deal term data in the lower middle market, which we define as 10 to 250 million of deal value. GF Data is 10 years old this spring. I got into this business as a deal professional and continue to be a partner in a middle market M&A firm back in suburban Philadelphia called Fairmount Partners. I think I'll be talking a little bit more about the data in a minute, but my M&A practice is an industrially focused practice with a lot of owner-managed private companies, and one of the interesting things about being in the data business has been getting to see the interplay between the deals that we work on in our own practice and the broader trends in the market. As Tom said, it's very interesting.
And I'm Tom Goldblatt, and I got into this business. I worked at companies before, running companies and doing a lot of acquisitions from that, and helping improve companies, and then working with private equity firms trying to find deals, and then it ended up kind of that the best spot that I really like is actually selling the companies, and I find that it's very exciting, and there's always something new, and what I like best about it is you do the transaction and you close and then you move on to something else. And our firm has become known as the preeminent special situations investment bank, although lately we're doing more and more non-special situations, and finding that our unique proprietary process and how we do it and selling companies as best instead of as is really works for driving up the value, and it's been a good run, and I feel like we're just really getting going. Having said that, let's get into the numbers, and Andy, we'll let you start off with some slides you have here, and then everybody will kind of respond to them.
Thanks, Tom. I think I'm going to go through 4 or 5 slides in 4 or 5 minutes. I'm even going to time myself because I know we're going to have a good discussion. Let's see. All right, talked a bit about GF Data. We now have over 2,000 deals in our database completed by private equity funds and other sponsors in the 10 to 250 range. The deals that get reported to us are in manufacturing, business services, healthcare services, distribution. Multiples of EBITDA are really the coin of the realm. So the other parameter is total enterprise value to adjusted EBITDA multiples, 3 to 15 times. We have quarterly reports online, searchable database. If you're interested in more information, happy to give you afterwards. Or call this guy.
Let's have the other panelists, there's like several, let's break it down and not, we want to talk about, values and debt and also deal volume. And a lot of what you've talked about so far is talking about, multiples. So let's kind of stick with that, and you also did a lot there of breaking into showing the huge difference between different size of deal. So we'll start with Eric, and this can be a conversation amongst the panelists too. But let's just stick on at this point, multiples and valuations, and talk about kind of where it's kind of at, coming out of last year and this quarter, and kind of, so where we're at right now. Eric, if you want to start with that.
Yeah, look, I mean, I think 2015, by almost any measurement, was a stellar year for the industry, right? I think the data that we just looked at sort of would bear that out, right? A large number of transactions that traded for high multiples, being driven by wide availability of capital of all forms, right? Whether that's a strategic company that has an enormous amount of cash on its balance sheet that it's looking to put to work, a private equity firm that's raised a large fund, hasn't been invested, or a bank that is similarly motivated to put capital to work. So all that drove those multiples very strong. It was a record year, I think, for almost everybody in the industry, and I would say we would echo that. We sort of came out of the end of last year, and the sort of very large buyout community, say north of $50 million of EBITDA, really was sort of shocked when the debt capital market sort of closed down on them, and it was largely closed for those large transactions in January, February. This was really driven by regulatory issues, right? A lot of the larger banks were really squeezed by the federal government and told essentially, to oversimplify it, we don't want you making these kinds of loans that are, sort of covenant-like, sort of very large and potentially risky.
You're talking about January, February,
January,
16.
Correct. Yeah, we entered this year with sort of that market in really kind of tough
Do you think
shape.
they were closed because of regulation? Because I think that's been affecting them for the last year, and I think the January, February slowed because of risk aversion. Because you got the alternative lenders, I think, picking up a lot of that from.
Yeah, I mean, I think if you talk to the large sponsors, right, they'll just tell you there was not that available in January and February.
Yeah.
Maybe it was some risk aversion too, though. I think the federal government was telling the sort of too large to fail banks, you cannot have these loans on your books right now. What I think a lot of us in the middle market sort of felt, and curious what other folks thought, was sort of a lot of sort of looking around at the lenders we dealt with was sort of, is this going to kind of trickle down? And what at least so far seems to be the case is no, that really hasn't. And again, the reason I think I sort of highlight regulatory issues is middle market loans are really what the government wants banks making. And so at the end of the day, I think they're not going to be under that kind of pressure. So yeah, at least personally, we've seen in our transactions, pricing has ticked up maybe a little bit. I think terms have come in a little bit. The banks are maybe slightly less aggressive in the terms they'll offer. But at the end of the day, the middle market debt markets seem pretty liquid.
Eric,
So we're pretty optimistic.
How would you assess the field of play between bank lenders subject to the regulatory pressures that you're talking about and the non-bank lenders that raise their capital in the public markets, and to a great extent they're affected by the high yield debt window shutting at the same time?
Yeah, no, absolutely. I think that was a lot of what was driving our sort of nervousness in that middle market debt market was, wow, are we going to lose these folks as well? But I think the fact that at least traditional bank lenders seem fairly liquid, we haven't seen it. I agree, I think some of the non-traditional lenders are out of the market or less aggressive, but it hasn't affected our ability to get transactions done, at least not yet.
Yeah, I would concur as well. I think part of what we've seen is that 2015 was so robust that we've had a tremendous amount of carry forward into 2016. So a lot of our early transactions that we're completing or we're completing right now really started that latter half of 2015. We are seeing, so there was a lot of noise in the public markets, I would say, in January and February with the high market volatility, but a lot of the alternative lenders also stepped up. So if you're looking at, folks like you're sponsoring today, Victory Park Capital, or folks like Monroe Capital that are lending to the middle market private equity funds, they're deploying a lot of cash. And then you're also looking at other data sources, including GF data, PitchBook, et cetera. New funds are coming out, so there's more liquidity, more equity that is going to need to be deployed. And since we are now, it appears, it looks like we're going to be in a low interest rate environment for a longer period of time. Yield is going to be hard to come by, and private equity investment is going to still, be out there. Where the folks in this room, they're all looking for deals, good deals to acquire, and we are seeing those multiples stay steady or trend upwards. Even in the small middle market. So it's an interesting time, and it's a fun time to be an investment banker right now.
Yeah. Andy?
And I concur with what both Greg and Eric had to say. Our experience, I didn't mention earlier, but our typical deal sizes are in the 10 to 100 million range. And in that bound of the lower middle market, the data that Andy showed here over the last couple of years of the kind of typical blocks of 3 times senior and 1 turn of mezz is where capital structures for our sell-side deals often come out at. And like Eric touched on, we're seeing plenty of availability from senior lenders in that end of the market. We had a couple of deals that were potentially going to go with a BDC in January, February that ended up going a different way. So that was our one touch point with the rumored tightening of credit at that point. But for us, at least, so far it's been mostly rumors rather than direct experience.
One further comment too regarding the market is, we did an analysis firm-wide kind of is who was buying our clients. And, truthfully over the last 18 months, we've identified that it's almost a 50-50 split between strategics, acquiring growth, and growth has been kind of hard to come by, especially that fourth quarter and first quarter of 2016. We saw slower marginal growth opportunities, and a lot of these strategics, especially in industries of consolidation, in industries where they need the additional revenues to kind of assist their margins, they're actively looking. So we're seeing, a nice mix of strategics kind of stepping up to the plate and saying, hey, we really need to continue to grow, otherwise the market's going to punish us. And then we're seeing that compounding pressure of private equity continuing to raise cash, saying we need to deploy this cash, otherwise we're not going to have any investments to manage. One comment I wanted to make to Andy and your comment regarding family business transactions and private equity transactions. And you know this as well, Tom. A lot more PE firms are touting, they're backing executives in that industry, they're providing operational excellence, they're providing operational improvements. If they're not doing that in this market, they're not going to see that accretion between the smaller transaction to that larger transaction. And they're making those decisions that the family members couldn't make. Because Greg was that long-term employee running inventory, and he sucked. And they didn't want to fire him, but the private equity firm is in making that investment into new technology or making an investment into new human capital that the family may have not done because Greg was hired by dad, and we can't dad liked him.
I think that 2015 was really 2 different years. I think it started off very strong. And I think if you look at the overall numbers, which show total deal value in 2015, and it was like a record year, I think it's somewhat misleading. Because I think a lot of those deals were super large pharmaceutical deals and other deals you read about in the paper, and inversion deals. I think the actual middle market actually had a slowdown, particularly in the fourth quarter. I think some of that related to the banks starting to feel the pressure from the Dodd-Frank, and then also from the multiples being high, is that the people that have been in the private equity for a long time are starting to feel that maybe it's too rich and just not a lot of companies coming out. I think when we got to January and we saw the stock market go down 15% or so, and we saw the the junk bonds go from what had been like 4%, it started in December, the yield went up to 9.5%, which is still not what is the traditional yield on those, it's above 10. There started to be fear in the marketplace, and we had some deals out in the early part of the year, and you could just tell from the private equity funds that the optimism was gone, that they just weren't feeling the same, and the lenders were starting to pull back. Yet even the alternative lenders, the business development corps or the BDCs, most of them had their stocks undervalued, and so they were feeling, somewhat pinched. And so it's starting to look like this year, and in M&A, the M&A magazine said that January was the worst month for M&A in 15 years. So it looked like things were coming to a real halt, and it looked like this year, and we do a lot of distressed deals, was going to be a hallmark for that. And we were kind of on a precipice of what would happen. And it seems like since that time, things have kind of stalled and maybe are starting to pick back up. And as far as even with the multiples, I think, Andy, when you get, and I'm guessing that we're going to see that the multiples are coming down some from their peaks, but we'll see. Maybe it's going to bifurcate on what type of company and what industry it's in. But when you look at across the board assets, we're in a global deflationary market. If you look at the price of all the commodities, if you look at agricultural, they've gone down. There's no inflation really. We're looking at best 2% growth. At the same time, companies are selling for much more because they've got all this capital chasing them. But there's kind of a disconnect, in a sense. So
that's what we tell our clients as well, Tom. We say, hey, if you can't reach your valuation goals in this market, I don't see a market that's going to be stronger than what we've just come out of and what we're still kind of participating in, albeit a touch lower than what it was, I would say, at the peak of 2015, 2012, when there were a lot of valuation activity there. But
And our experience matches Greg's, where our deal activity under management continues to be very strong, and valuations have continued to hold up. I'd say, in contrast to your experience of kind of a 50-50 split, strategics and private equity, probably over the last 2 years, maybe close to 75% of our deals have gone to larger publicly traded strategics. And it's not through any direct segmentation of effort on our part. We typically run broad processes in order to maximize value in terms, but it's a lot of larger strategics in healthcare, particularly a couple of consumer deals we've done, have stepped up to buy growth and new product innovation through these add-on acquisitions. In terms of where the market's at for us, where we're seeing it, and where we're a little nervous, is that pitch activity seems to be slowing down over the last month or two. I'm hoping it's not statistically significant for us yet, but I'm curious what the rest of you are seeing in terms of new business opportunities.
No, I hate to agree with you, but I do. It's been slower. Not the last couple of weeks it's sort of picked back up, and maybe that sort of speaks to Tom what you were talking about. There seems to be a firming up of the ground, but pitch activity has been slow the last 6-8 weeks.
Well, there are always two ends of the pipeline that people focus on, and I think there's no doubt. I mean, all of the data houses showed a drop off in completed deal activity in the final months of 2015, and there's every reason to expect, Tom, what you said, that the doldrums will continue at least in the first part of this year. But it has seemed since then that people have been busy on closings and transaction activity, and it may be that when you look at the fundamental, at the good fundamentals that continue to be present in the market, and ask why there isn't more pitch activity. It could just be that that end of the market is pausing because people are busy getting stuff done. I have a theory that I wanted to try out on you guys about the quality of the pipeline, the relationships and the engagements that you have come to market. And it's an answer to this question that people ask, that after however many years of a good market, has the pool of quality businesses been depleted? And the theory is that there are two pools. businesses owned by private equity firms and then businesses in individual or private hands, the first pool is more fished out for the reasons that we've been alluding to. Because financial buyers are more informed as a group, less sentimental, have a recognition, Greg, of what you're saying, that the market's only going to go in one direction. It's never going to be this good. And think of how many sponsors you've known who, over the past few years, have said, "Yeah, we're net sellers, not net buyers now." Whereas the family business owners, are none of the above with respect to those characteristics. If they own a successful company, they're still taking money out. They're a little bit lulled into believing that good market might become a little less good, but it's not going to tank. So the theory would be that pool is less fished out, and what we all as intermediaries are likely to see therefore is more of those private businesses continuing to come to market with the added work that needs to be done to prepare them for sale and for valuation to hold.
So let's talk about, just for a second, why do the smaller companies go for so many fewer terms? Why is it that, small company, which you can argue there's more opportunity to improve it and grow it, and the bigger company is harder to get growth, but it's a huge amount of difference. What's your opinion?
Well, there's more opportunity to grow it, but you don't have to pay for the growth that you're going to accomplish under your own management, I think is a big part of it. And then it also gets back to the leverage point. I alluded earlier that most of the transactions we do are the typical 3+1 turns, and that I think sort of caps the total valuation we're going to look at that end of the market.
We do a fair amount of some smaller transactions, and I'd say the hardest companies to sell today are those companies with EBITDA south of, I would say, $1.5 million in EBITDA, right? And the reason is you have a declining pool of qualified individual buyers. So we have these robust SBA loan programs and senior debt programs. The job market's pretty strong for professionals. So, MBAs coming out of grad school, finding jobs with private equity firms or large corporate USA, we're seeing a lack of talent, qualified business owners that could afford, that $1 million plus EBITDA margin company. And that's putting those valuations at a lower or normalized function where you haven't seen the wild swings where we're at with the $25 million enterprise value in the club.
Conversely, though, Greg, you've got the emergence of the search fund model that I think people are coming with capital into that lower end of the market, so that's a new buyer class.
But it's still a smaller pool of suitors because even though they're partnered with a private equity fund or a family office, that family office or private equity fund is still looking for a little more scale. They'd rather deploy a little more cash. And if you're at $800,000 or $1.2 million of EBITDA, it's not as interesting unless you have maybe a strategic suitor.
If you move a little bit further up market in terms of size, in the kind of call it 3-4 to 10 range, right? I think you still see probably, if you were to cut your data, a discount generally, and I think that's largely due to things like concentration issues that these companies tend to have. I forget who it was in the panel. Someone was speaking about some of the infrastructure inside a company that a larger, more robust strategic or private equity firm would look for that just isn't there. So there's some work you have to do, some sort of blocking and tackling. What I think is interesting, to me anyway, is when I look at transactions that size that are sort of outliers in the positive range, right? Like what allows a company that size to get a 7, an 8, or a 9 multiple? Because it does happen, and how do you achieve that? And I really think it's a lot of it's where either they've addressed some of those issues, right? Like concentration, whether it's customer concentration or whatever concentration, either they've addressed it or there's a clear path to how you address it, and you're able to sort of walk a buyer through on how they would address that.
We took a look at this GF data in the middle of last year. The size premium it was interesting that when you look at if you went by industry, you look at this 2-turn spread on average between larger and smaller deals. And I think it was 10 to 50 million in value and then 50 to 250. And it worked out that about half of the spread was some of the factors, Eric, that you're talking about that have to do with scale. So that was one turn, and then one turn was debt availability, or at least debt utilization.
Makes sense.
And I think that is a huge part of what's happened in the market. We were talking more earlier about bank lenders, but I think a big part of the story of the past 5 years has been the displacement of cash flow-based lenders by these non-bank capital providers in most of the country.
Yes.
And Chicago is an exception.
Not really.
Well, having the handful of banks resident here that still have an appetite for cash flow-based lending and ability to be competitive. I would say Chicago, Texas, and maybe Southern California. But the East Coast, where I'm from, and the rest of the country, the BDCs and the other non-bank lenders dominate that market, and they are not interested in sub-5 reality.
I think that's a great point, and I think another thing that we, first of all, if I had to choose between a company that's doing $200 million and lost $15 million, and a company doing $10 million and making $2, I'd rather sell the big company. The size is a bigger problem for us than the distress. And then why is it that that it's so much harder to get a value? I think what it is what we see is that you lose when you have a sub 10 and sub 5's even worse. You lose most of your private equity funds, your risk buyers, and the lenders too. And I think what it is a trickle down also from the public market, so that there's a premium on public market, whether that really should be there, but a company that as soon as they go public is worth much more. There's like a 12 time or something just for being public. And so I think, and you have a lot of the largest private equity funds now are publicly traded. So I think what you're seeing is this premium that's trickling down from the public markets. I think in reality, there's better deals to be made with the smaller companies. There's more you can do with them, and there's but you just lose 90% of the buyers will just say we're not really interested because of the size of that company.
Plus, it's also financial statement integrity, right? A lot of these smaller privately held businesses don't have bank debt. So they're not requiring their CPA firm to do an audit or a review. They're like, hey, just do a tax return and give me a financial statement at the end of the year. And if you don't have that, consistent reporting to a bank and filling out the borrowing base and managing covenants, it's going to keep the pricing down a little bit.
One thing I'd push back on, Tom, is I agree with all that except the drop off in the number of buyers. And when I started investment banking over a decade ago, I think it was true when somebody gave you the pitch that we serve the underserved 2 to 5 million EBITDA niche. Now 90% of the people we run into do serve that underserved 2 to 5 million EBITDA range. So I think there's plenty of capital out there for that.
That's why I said 2 million and below. I say $1.5 million and below was the hardest getting done. With $2 million, we did a deal last year. Was private equity bought, and there was a lot of interest in those high multiples.
The $3 million EBITDA deal is, is a generalization, but that's pretty hard to sell also because those businesses are a little bit closer to sniffing these higher valuations. I don't know that the $1.5 million guy, but in addition to the problems that you're talking about with the $3 million EBITDA business owner, is that he's coming in and it's like he's making a concession when he says, there are deals in my industry getting done at 10, 11 times, I'm a little smaller, so I'll take an 8. And you look at the business and you think it's a 5.5 or a 6. And that's just a tough dynamic.
I think in this market, he's getting closer to an 8, unfortunately.
You really think so?
If it's a clean $3 million EBITDA business, we're seeing high values.
We just did a $3 million EBITDA business at 8.5 times.
We're seeing it's a strong market. It's
Well, I think it depends what industry they're in.
Absolutely.
If there's growth. And it's interesting. Not interesting. It's upsetting for me, but it's like there hasn't been as much distress going on in a sense. I guess
it's coming.
But it seemed like at the beginning of the year there was just going to be an avalanche, and as we talk about the values being high and the lending, and the one that ends up buying the company obviously is paying the most, and the lender that gets the deal has got the loosest framework and willing to give the most. But and then you've got oil and gas is certainly very disruptive. But you had all the metals and stuff. But it seems like there was talk at the beginning of the year that the workout departments are going to start getting busier at the banks, but it doesn't seem to be so. Do you guys see it coming, or what do you see happening with the
For us,
distress?
it's been industry specific. We do a fair bit of turnaround and workout. We just closed a deal in January with a manufacturer of test equipment for solar panel manufacturing. So that was the distress they were experiencing wasn't capital structure, it was very specific to industry pricing.
I'm curious to poll the audience here, because I look out and we've got a lot of deal makers out here, and when I'm talking to a lot of lenders, it seems that when they're sober, they're telling me everything's well, and then after a couple drinks, I start to hear some sobbing and stuff. So, but as far as all of you just about everybody here is in the deal market one way or the other. But would you guys perceive that the deal market is, right now, kind of normal or super slow? Who thinks it's like, kind of, normal right now? Ralph, Tom, and Jasmine, Peter, and who thinks it's like really actually super slow right now?
How about just slow?
Slow. Who thinks it's slow? So a couple more on that. Most people didn't seem to have much of an opinion on it. So,
Well, you
let's
didn't
go.
ask for robust.
Who thinks it's robust? You do. Yeah. Well, and you do buy side work mostly. So you're seeing in your you do a lot of calling and stuff. So you're seeing a lot of people wanting to sell now from your
More people want to buy.
wanting to buy. Okay, wanting to buy. Yeah. And Mitch, what are you seeing as far as in the asset big? You've got a lot of clients that have owned their businesses a long time. They've been their lender for decades. What's their attitude out
For
there?
decades. That was kind of painful. You know what, you're talking about distressed sales, okay? No owner wants to sell a distressed company because he's probably more or less out of the money. So it has to be forced by either a bank or creditors or whatever. And right now, with interest rates low, commodity prices low, energy is low, even these guys who are doing relatively badly can muddle through and hope for better days. I think that's why you're seeing slower distress. It's not that.
But are they thinking of selling now, the ones that are doing okay, or are they just holding?
The ones that are doing okay are thinking about it. See, I mean, someone said it, Eric, I think it might have been you. Growth has been the real problem that most companies have had over the last 3 or 4 years. And they want to sell when they're showing growth. And there hasn't been as much growth over the last, sales growth over the last 2 or 3 years to show that great story that people think they need to really get that higher premium. I think they're waiting for that big contract to come through or whatever, as opposed to trying to sell a company that has had relatively little growth, even though they're kind of getting by and doing okay.
Thank you. It's been informative.